morning, ladies and gentlemen. We are pleased to welcome you all at National Bank of Fujairah Knowledge Series Event 2023, organized in partnership with Refinitiv, a London Stock Exchange Group company. My name is Umair Ansari, and I will be your host for today's event. This event is part of NBF's knowledge sharing efforts, which will run throughout 2023. The theme of today's event is corporate tax, which is likely the biggest legislative development in the UAE this year. Today, we will speak about the outlook of the UAE's economy and explore the implications for businesses ahead of the sweeping reforms to the country's tax regime. We hope that you will take advantage of today's sessions and encourage that you interact with our speakers and network with your fellow industry peers. Without further ado, may I now invite National Bank of Fujairah Deputy CEO, Mr. Adnan Anwar, to formally open the session for us today. Thank you, Mr. Adnan.
Thank you, Mayor. Good morning, everyone. A very warm welcome to all of you. We are extremely delighted to have you all in this room. I think after pandemic, this is our first Muhammad event under the Knowledge Series banner in Abu Dhabi. So it is extremely fulfilling that finally we can have sessions like these in person. I think when it comes to our brand attribute, one of the key things is to look after each other, and perhaps it's a shared responsibility. And forums like these help us to share our experiences, learn from each other. We all are navigating through times which continues to be uncertain, various changes and challenges which we all are navigating. So corporate tax in our part of the world is a new development where we all have to learn from each other. New clarifications are coming. It's a long journey. And I think we all are on it. So I think today, through the experts we have in partnership with Refinitiv, there will be an opportunity for us to learn. And the more interactive and the more questions you all can ask, it would be more informative. We also allowed today a brief session on the economic outlook and perspective as well, because a lot of things are developing, and you may still want to pick brain of an expert asking few relevant questions. So there will be an opportunity in the beginning for that, and I hope you enjoy that. From NBF perspective, as your partner, I think if I cover a little bit about ourselves. So after our record operating performance last year, we started Q1 on a strong note, and hopefully with your support, we can continue that for the rest of the year and achieve our new record net performance this year. We are being recognized for our services and strengths consistently externally. So we were recipient of the awards like Best Commercial Bank, Best SME Bank, Best Trade Finance Bank, and recently Best Islamic Window as well. So thank you for all your support. So we value your partnership and trust in us. Without further ado, I think I would let Umair carry on the formal proceeding, and I'm sure you look forward to the speakers more than me today. So all the best and good luck for the session.
Thank you so much, Adnan. Now, we will start with our very first presentation of the day, which will provide you with an update on the economic outlook, including an overview of the UAE economy. Our speaker for this session is Nikita Pavlov, EMEA Director, London Stock Exchange Group. Nikita has multiple years of experience in various countries across the EMEA region at the London Stock Exchange Group. He joined the company with an impressive background in economic and financial research. Mr. Pavlov, if you can join us on stage, please. Thank you.
Everyone. Thanks. So it's a pleasure to be there and see the properly filled in the ballroom. Thank you for coming today. It's a pleasure for me to be with you today, and we have roughly 40 slides, and please fasten your seatbelt. We're going to have 1 hour deep dive in macroeconomy across the world. So without further ado, actually, let's go to the slide number 1. And today is 23rd of May. And it's almost the quarter of the year, and actually that's the time when many traders, many economists trying to say how 2023 was for them. For those of you who are looking for the prices since the beginning of the year, you actually might notice that the Brent prices, which shown on that slide behind me, actually they were positive, they were negative. The same we could say about the silver, but I'd like you to pay attention of the behavior of the United Kingdom 10 years benchmark, where it stays versus South African 10 years benchmark. So if you could compare two economies, like the United Kingdom economy and the South African economy, with all respect, it's just uncomparable. But at the same time, behavior or decrease of the 10 years benchmark is quite look like to each other. So today, during today's session, actually, I will leave a few open questions for you guys, just to create your own thoughts about how it's going on, what's happening on the market. So that would be one of them, right? So, and closer to my session, I hope I will give you a few answers. And after the session, please feel free to discuss it in our coffee breaks. However, speaking about the markets itself, and in the agenda say that we will speak about the commodities, indeed. And for us, based in GCC, commodities predominantly that's oil and gas. But we shall not forget about such commodities as precious metals. And if you remember the February, it was absolutely everywhere, and I believe only, I don't remember any tabloid who didn't say, oh, seems like silver is a new gold, because silver's price was hiking, and everyone's saying, oh, yeah, seems like the gold is overheated, and we need to invest more into silver. So look at the dynamic as of today, right? So they grew up that time in February by 20% year to date, and now it's barely around zero. So what it says that actually, if we could, in one word, just say what 2023 is, that's a volatility. Volatility is good for sell side, for brokers, because if you're a stockbroker, that's the best time for you to make money because your customers playing on the market. However, for the buy side, for people who do investment, real investments like you do, it's actually times when you doubt about what I have to do. And that's actually very much reflected to the next slide. Another big news we had in March this year, seems like dollar is no longer the asset which is strategically the world considered as a asset to invest. So that slide behind me shows the total allocation of the whole central banks across the world in what currency they invest to. If someone says now, 2024 Chinese yuan gonna be the new main currency. If you look behind me, actually seems like it won't. US dollar is still above 50%. And for such kind of things, it's quite complicated to say that something might happen so dramatically that literally most of central banks will say, oh, okay, we don't invest into dollars anymore. But that's not enough. They have to sell it. So just imagine how huge collapse might be if such amount of US dollars, hard currency, as a reminder, right, would be sold into the market to buy what, to buy where. And that's actually the question. It's not even a question. It won't happen within 1 year. So, and if you look into the chart, you see there is small downtick over there. And for those of you who remember American history, that was the time when the President Donald Trump been elected, right? So many countries were threatened that the guy who is doing cowboy economy actually might ruin US economy, which didn't happen because we see that it's like later to his period of the presidential, then Mr. Biden administration, it actually reverted back to the levels above 50%. However, Chinese yuan picked up a few positions, but British pound lost some, and the answer of that will be later. So, rates. And that's an important thing because now, specifically for me, as far as I'm looking for a mortgage, it is quite personal question now, when they goes down, and I'm speaking with my wife over the evening, is it a good time now, or maybe tomorrow, maybe next week, maybe in a quarter, maybe in a two? So the last time United States of America has the same Fed rate, it was over there, and it took 1 year. So, and after I prepared that slide, I was like, okay, the main lesson we have across the whole financial markets and economy, it loves history. So if it happened once, most likely it will be repeated. More or less pretty the same, but it will be repeated. So, and that's my honest opinion, my humble opinion, not related to LSEG or Refinitiv, but it stays like that for another 9 months to 1 year on that level because economy needs a cool down. Now, there is 1 year before the next presidential election in the States, and one of the Trump vows, it was in the middle on the slide, that's actually, I will fix the war in Eastern Europe, and I will fix the inflation. And that's extra pressure on the current presidential administration because they need to do something about that. But first of all, and if you look from the perspective of individuals, they much more care about inflation rate instead of key rate. Because key rate does mean nothing for me if I'm an individual person. I go to the shop to buy some stuff, and if water prices grew up like 10%, that's what that's noticeable for me. Key rate 5%, 5.25, okay, that's a quarter up, so what? As an individual. However, for an organization, that's slightly different, right? Because we all need to run the projects. We all need to borrow money sometimes to develop something, and we need to expect or to calculate return on investments. So, in a few words, and one pyramid, actually what it all matters. The hiking of the key rates, increasing of them, is actually having multiple consequences. And I don't want to read that words on the slide, but on the bottom, it actually says that many, many people and small businesses might struggle because CPI is growing, value chain price is growing, and that's the time maybe to tighten up your belt or do something different. And actually, we're heading to the COP28 this year, and I had this conversation multiple times across last 5 months. Oh, Nikita, you're saying that it's turbulent time, so does it mean that we have to put some cash under the pillow, lie down on it? I said, yeah, that's a good chance just to burn money. Because remember, whenever you have some cash, right, so there's like some open resources, and you just put them into somewhere like a pillow, like safe, like physical, theoretically they're just burning out. Depends on the currency, right? If you have Turkish liras, that's 20% of your amount would be burned out for the end of the year. And if that's dollars, it's still quite a huge number. That's around 7%. So what I'm saying that actually that's the time to make hard decisions, or better say, smart decisions. Because whenever you'd like to run the project, you have to be twice more careful. You have to recalculate your model 3 times. If previously like, oh, we need to do that, okay, yes, that's the money, please do that. No, actually the smart moves means we need to do that, okay, what does it mean for us? And it's not only the revenue expectation nowadays, it's actually what our competitors do. Because any turbulence time would be over, right? Again, that's the history. We remember 2008, 2014, 2000 pandemic, and still remember what worse could happen. So many things. So we have to recalculate, we have to be smart, we have to have great providers who will help us, who will guide us through, who will help us to hedge our risk. And all of that together is actually about to have a smart investment into real product, real projects. And once the turbulence is over, when you look back, you will literally see that most of your competitors did nothing because they were scared, they were pulling money out to just pick up their wealthy life, whatever. So that's the right time to do smart projects. And if you remember 2008, Fannie Mae, Freddie Mac, I believe most of you remember that time, that companies who were struggling And I still remember a few, Yahoo.com is a great example, and what Google did. Google said, okay, that's the dark times, we will hire more people from another organization who will teach us how to work differently. So once the 2008 crisis was over, in 2009, it was July, August, we officially said it's over, but it still was like a huge gap to the previous prices. Google came up as the world leading search engine with multiple ecosystems around. With all respect to Yahoo.com, it's still, how many of you had Yahoo.com email box, right? I had one. I don't use it anymore. And that's the example that any crisis time is just the time to think smarter, to think better, to analyze your models. And actually coming to the investments, and most of you, some of you at least, definitely has investment portfolios. And speaking about that, if you look behind me, actually on the bottom, where is the best performers from the total return in US dollars, and that's important, right? So all of them recalculated, there is no FX exposure on it. Actually, you will see Mexico, Argentina, Greece as a total top performers from that perspective. And actually it shows that it actually shows two things, that the interest to emerging markets is growing, and the second thing is that many people who told me in March and April, that was one of the Financial Times as far as I remember, world asset managers reconsider their portfolio ratios in terms of having 80% of fixed income allocation. Oh, poor people, look at the total return. I mean, fixed income is a great instrument. As a part of your saving, it's like less risky investments. However, equity is doing much, much better. And again, that's the global benchmarks, right? So it's not one particular instrument, it's like much, much more. So this slide doesn't have any words. And the reason I didn't put at least a word is just because of the blue bar. Blue bar in October 2022. Let's do a step back and I will tell you a quick story what happened in October. So October last year, a bunch of economists said inflation rate is going up. That is like, it's unstoppable. It's like a snowball. It's growing and growing. And in October, that was one of the first time, and later on, states did it like multiple times, they published CPI data revised. So they said, if I recall correctly, that August data was 3.4% inflation, and then in October they said, we changed our way of calculation, thoughts actually, and it was 4.2. So that's exactly the time when asset managers, so just imagine the whole asset management world, they said, okay, we will go to the money market contracts, predominantly deposits, and as far as that's money market, it's like within 1 year horizon. So that's exactly the reason of that spike. And many customers, our partners, challenged me about saying, yeah, look, but S&P was growing since the beginning of the year. You just showed in the previous slide that it was like plus 15%, different time during this year, right? So the S&P is growing. How come that money market is doing so great in terms of inflows? So that literally shows that asset managers started to invest more into money market instruments. I said, yes, that's true. If you look into the S&P 500 and the performance of that index, only 4 equities from top 5 performed well. So if you took the constituents of S&P 500, you will notice that 490 stocks actually went down since the beginning of this year. And only a few were performing, Tesla, Apple, all of them. But after yesterday announced of Elon Musk that they cut prices for Tesla once again, I'm not sure that they will perform, but still. That's very important. Why? October 2022, that means that these instruments would be legit until October 2023. Obviously, with an expectation that the key rates might go down, they might to move into some different instruments. So if you have something good right now, like in cash, and you don't have open projects, so maybe behavior of the global asset managers as a good example how you could spend your time and money until we have good rates and quite classical secured instruments such as deposits. Speaking about the deposits and coming back to the GCC region, specifically the UAE, I do love the chart because it shows the total deposits in the system. And what I do like more is actually the green bar on top of the blue one. So since 2008, and we speak about that like multiple times today, since 2008, the green bar in the percentage growth is growing much faster than the blue one. So it tells us a few things. The first one, non-residentials started to trust and believe more into the UAE economy. Point number one. Point number two, specifically now, UAE currency, together with economy, it is a good proxy for US risk exposure because it's very well correlated, right? So whatever US decided about the key rate, we see the implementation over there. So could it be used as proxy? Yes, definitely it could be used as a proxy, and actually global investors sees that. And the third thing, it's smarter decision from the UAE. So it's like it's very much welcome foreign money. So it's like, yeah, please come. There are a bunch of different zones you'd like to make a business. We are much more welcome than it used to be, and we all sees that especially during the pandemic time. So that trajectory is going up. I don't think that we see the downside anytime soon. So what another important thing about GCC countries? Oil prices. And that's definitely one of the most frequent asked questions for me. It is like, what do you think about oil prices? Again, we as Refinitiv, as LSEC, we collect a lot of contributors' data, which you see on the screen. And I put that specific, especially that yellow line, and one of the partners said, oh, I need to know who that crazy guy who said that the potential maximum level in 2027 going to be $160 per barrel. That's Brent prices, right? And frankly speaking, yes, and that's the reason I put all of them together. And just to let you know, I ran the same slides in April this year. So the previous maximum expected level was 130. So over 1 month, it's been changed. And again, one of the reasons, because guys from Morgan Stanley said in the beginning of the year, they say that we expect that oil demand will rise up by 36% during this year. Again, there are many reasons of it. Opening of Chinese market. We actually all know about the Emirates and Etihad partnership, that numbers of flights are growing up. So it's still, they're using the oil, right? So it's like air fuel is still part of the chain. And the plastic, all of it is made from plastic. And even we speak about EV, electric vehicles, right? So you would be surprised, they're not so much without oil, because still the plastic is done from oil. The wheels by itself, it's also the product of the oil. And we could not say right now that there is at least one reason why it shall go down. However, just to keep you on the positive thinking, the price expectation is pretty much flat. So within the next 5 years, global economists, not me, global economists, it's like more than 50 names, in average, they say that we're going to see the range of $75 to $85 per barrel, and that's the reality we'd like to live. For those of you who run DCF modeling and you'd like to have pessimistic and realistic scenarios, here they are, $160 per barrel. Definitely will have quite a crazy results, but yeah, we all do modeling, and you need some extremums, so that's one of them. So moving next is actually the equity market of the GCC, and if you see there, overall indexes in MENA perform well. They do not perform great, they do not perform bad, they're doing well. They around the opening levels of the beginning of the year, but I'd like to pay your attention that since the beginning of the year in MENA happened 19 IPOs already, right? And we know that the 20th one is coming with ADNOC Logistics, right? So the dividend yield for equity investments for equities is 3.5%, which is quite good. And again, that's another reason why people keep investing to equity. And you remember that total return analysis done fixed income versus equities. So dividend yield is quite high, frankly speaking. And what's more important is actually the growth of market capitalization. So it doesn't matter how indexes perform if you're not buying them, right? So it doesn't matter. But what's important is the size of the market. And since the beginning of the year, it's grew up by 7%. So that's literally a very symbolic analysis how much we expect that the global markets could grow and MENA market specifically. So 7% is a really, really good number for May months, right? So it's still 5 months since the beginning of the year. Yes, we said that it's close to equator, and we made already half of the year, but still 7% is quite good. Coming to the another one, and or better say, moving back to the deposits and money market, as you could see behind me, and please pay attention that the red line, the Egyptian pound, is on the right-hand scale. That's very important. So they perform more or less equally to each other, and there is no hidden risks over there, at least what I could say, because they're quite harmonized. They just call to the market reality, right? So it's like if somewhere, like States, Europe, the deposit rates going up, you couldn't stay on the side of the road saying, no, I will not do something about that, because obviously the global investors, they will just switch their attention into other markets, which is quite good now. So, and we coming to the last slide, and if you remember on my very first one, I've told you that there would be an open question about UK benchmark versus South African. On this chart, there are 3 currencies, but not against each other. That's currency index, so it's like different methodology. So what it shows specifically, it shows how currency is strong or weak by itself. And if you see, I hope you do, that the green line on the bottom, that's the Great British pound. And the downside of that is actually when Brexit happened, like physically, when Boris Johnson left his chair, lost his chair, and actually after that it moved up, but it's still not so good as euro and dollars. And that's actually, maybe that slide, the answer for everything. So that's another example or reason why GBP is no longer reserve currency, why US dollar is still above 50% as a reserve currency, and why UK 10 years benchmark behave the same as South African benchmark, right? Because it's very uncertain future for the currency, I could say. However, euro and dollars, they're quite correlated, I could say. Obviously, dollar did a bit better, but if you see the time when dollar went up, the British pound went down. So it's like it might be reconsideration about the investments. So the last thought I'd like to leave with you, 2023 is definitely showed a really huge turbulence, volatility, and all of that already happened. And do we have a dream or thoughts that 1st of July it will stop over and nothing like that happen? No, it's definitely not. It's still a number of signals on the market that at least within the next 6 months, it will continue. And the way to play with it is, dear colleagues, up to you. Because the way you operate with the risk, the way you build your models is actually just the beginning of your success within 2024 and all of that. So thank you very much for your attention. That was a lovely session. That was great to have you. Please feel free to catch me up later on the coffee break. Thank you.
Thank you, Mr. Pavlov. Lots of ground covered there. Thank you so much. That was very informative. Our second session is an update on the UAE corporate tax law. And I would now like to invite Mr. Mohammed Al-Swifi, partner Ernst & Young, for his presentation. Mr. Mohammed is a partner in business tax services at Ernst & Young MENA and brings 23 years of experience in industry and professional firms. He is specialized in corporate tax, international taxation, and an expert in corporate restructuring and internal reorganizations. Mr. Mohammed, please join us on stage. Thank you.
So I think maybe as a starting point, just to understand the purpose of, issuing the corporate tax law. So why the UAE decided to issue a corporate tax law? Is it for revenue generation? Is it to manage the gray list and black list that actually UAE was part of in the last years? Is this something which potentially could be more global? So again, I think the main thing or the key driver is considering the fact that actually there is Pillar 2 and development from the OECD perspective that actually there will be a global minimum tax rate, which will be included and adopted by many of the jurisdictions. More than 140 countries already considered this kind of development and willing to be part of the Pillar 2. So definitely it was very, very important for the UAE to think about, why not to have a corporate tax? Because simply, in the absence of a corporate tax law, it means that actually for the multinationals that are operating in the UAE, for whatever operations and income which is being generated in the UAE, it's going to be taxed outside the UAE. So it is really wise that actually to think about why not to have a corporate tax regime in the UAE, and of course making it as efficient as possible, making it as friendly as possible, but also consider the fact that actually to consider that these kind of taxes, given that it's going to be paid somewhere else, so why not to be paid in the UAE? Which is definitely, given that the operations have been already covered and taking place in the UAE itself. So with that, I think I have prepared a few slides which we are going to go through the key features and an overview of the corporate tax law. And of course, we are going to have a few other sessions, so definitely we are going to cover any of the questions that you may have on what I have discussed. Just a quick overview or key highlights on the tax law. So the tax law comprises of 20 chapters, 70 articles, 22 possible elections or applications that can be done by taxpayers. And there is a difference between an application and election. So application is something that actually you have to apply for, you have to send to the tax authority, you need to get an approval in order to proceed. Election is something that in your hands. So while we are preparing the tax return, we have to select this approach or that approach, this option or that option. Also, we know that actually there is a number of areas which are not clear in the law. So we are talking about more than 40 points which are waiting cabinet, ministerial, or tax authority decisions to be out. We have seen during the last period, the last weeks, and maybe starting from March time and April. So there are the ministry, or actually the Ministry of Finance, has started to issue and release the cabinet and ministerial decisions, which is going to support and clarify many of the articles in the law, which was very, very helpful so far. There is a way to go, actually. So actually, all what has been released until now is only 13 decisions, from tax authority to cabinet to ministerial decisions. So we are waiting a number of other decisions to be out. When the law was issued, there was also, these have been supplemented by 158 frequently asked questions, which provide some sort of clarity to the key provisions in the law. Of course, it's not legally binding, but the intention at that time is to provide a level of understanding. Later and very recently, during the last 10 days or so, there was a explanatory note which was issued by the Ministry of Finance. So this is very, very helpful document because actually it talks about the law in a more friendly manner. It captures the ministerial decision and link it to the provisions of the law. This document or this explanatory note is going to be updated as and when further decisions coming out and as and when further clarity from the ministry is out. So it will be an updated document. It will be updated as we move on. So regarding the rate, so the law has provided two key rates, 0% and 9%. And there is also a threshold of 375,000 dirham as, within the taxable income. Once we arrive at the taxable income for applying any particular rate, we have to carve out 375,000 dirham. This part will be subject to 0%. One of the very important things to consider as well is actually what is the rate of qualifying free zone persons, and we are going to cover this in a level of detail. But the understanding according to the law that actually qualifying free zone persons will be subject to two rates, 0% and 9%. 0% on qualifying income, or when they are qualifying and actually considering the conditions for a qualifying free zone person. So they are going to apply at 0%, and any non-qualifying income, it will be subject to 9%. So potentially, a free zone will have two rates to deal with if they are generating non-qualifying income. We have also to consider a very important thing, as I have highlighted at the beginning, that multinationals. What about multinationals? Are we going to see a different corporate tax rate? Potentially, it wouldn't be another corporate tax rate, but however, it will be new rules, new Pillar 2 rules. So the Pillar 2 in its own, it will have a different kind of adjustments for Pillar 2 purposes, and ultimately it will be subject to a certain rate, which, as we all know, that actually the global minimum tax rate is 15%. However, there will be consideration for whatever corporate tax which is being paid in the UAE. So again, if it is 15%, in applying the law, we are going to do computations. We are going to consider what has been paid on a corporate tax level to the federal government and what is left as a top-up tax to be added to comply with the Pillar 2. This will be the additional tax to be paid. Of course, the Pillar 2 regime, definitely nothing has been issued by the UAE government. It will be something that will be provided in the same way expected, similar to the corporate tax, in terms of there will be a consultation document expected, there will be feedback to be gathered by different taxpayers, and ultimately the ministry is going to issue the Pillar 2 regime. So who is subject to corporate tax? And here we are covering the key elements and the key tax persons who will be subject to corporate tax, starting with resident person and non-resident persons. So these are the legal persons. So resident persons is any incorporated company in the UAE. This is considered a legal person subject to corporate tax. It also includes non-resident persons who are effectively managed and controlled from the UAE. This is very, very important concept. This is an international tax concept that if you are being managed and controlled from one country, however, you are incorporated in a different country, then potentially you will be registered for tax purposes where the effective management and control is taking place. So the UAE has adopted that concept, and it is part of the residency person's definition. Non-resident persons, so any non-resident person who is operating in the UAE through a branch, through a PE, this would be subject to corporate tax. And again, we highlighted the point regarding permanent establishment. So again, whenever there is a permanent establishment that has been exercised in the UAE through a fixed place of business, meaning that a branch or an office or agency PE, if, for example, the non-resident person has used or has a dependent agent in the UAE who is acting on their behalf, negotiating contracts on their behalf, then this is going to create what we call as a dependent agent PE. So this will trigger the registration of the non-resident in the UAE. The law also provided, when we talk about the permanent establishment, the last point, any other form of nexus, and there is no current definition for a nexus, and this is one of the very important areas that will be clarified as part of the upcoming ministerial decisions. But maybe if we think about nexus, so potentially it could be any other thing other than, agency PE or a fixed place of business PE or a project PE. So again, it could be any particular service, any particular project which linked to the non-resident. Potentially this may trigger. It may also include a reference to pillar 1, which is the technology and actually the digitalization, which potentially maybe it will trigger, the organizations which are dealing with the digital economy to be resident in the UAE as well. Natural persons, and this is one of the areas that many of the taxpayers or many of the individuals thought about and were asking about it. So recently, the cabinet decision was out clarifying what a business or business activity for a natural person is, and because actually this will be the triggering point. So if a natural person means an individual like us, is performing a business or business activity, then that person will be subject to tax, subject to corporate tax, meaning that has to register for corporate tax and has to file tax return. But what is a business or business activity? The cabinet decision was issued and it clarified that business or business activity should be anything apart from wages, which is salaries, bonus, anything that actually we are being paid for. Again, it's doing a particular activity. Anything apart from personal investment, as long as that personal investment is not or shouldn't be, is not required to be licensed by any of the licensing authority in the UAE. Also shouldn't include any real estate investment as long as this real estate investment also doesn't require any particular licensing from any licensing authority in the UAE. So if the person is doing or getting an income from any of these three, then this will not going to be considered as a business or business activity, right? Provided also if for example, there is a personal activity or personal investment or actually real estate investment which require licensing from a licensing authority, there is also a revenue threshold for the person to be subject to corporate tax. And the cabinet decision clarified that this revenue threshold is 1 million dirham. So if the revenue is more than 1 million, and it is licensed, then the person or the individual has to register for corporate tax. Free zone persons, so these are legal persons, and actually it is part of the resident person. So, legal persons who are incorporated in a free zone, this would be considered as taxable persons, noting the following, which is the qualifying free zone person. So actually, by default, or the default position that a free zone person will be subject to tax, right? But is it 0 or 9%? This is the conditions that need to be fulfilled in the first, in your left-hand side at the top. These are the main conditions which will clarify what a qualifying income or what are the conditions of a qualifying income. And if these conditions are being fulfilled, then it will be subject to 0%. So the conditions are, earning qualifying income, and this is a very big question mark. So what constitutes a qualifying income? This is something that definitely we are waiting for the cabinet decision to clarify. But if we go back and remember the consultation document that was issued before the issuance of the law, we may go with the minimum at least, because there was many areas that actually was clarified to be a qualifying income. But actually, if we consider the least that could be, if we can say we are safe to consider that this is a qualifying income, we can mention, income from a free zone or foreign income. So any foreign income which a free zone entity may be generating is considered to be a qualifying income, because actually the purpose of a free zone entity is really to deal with similar free zones in the UAE and also with outside the UAE. So I guess maybe it's safe to say that actually potentially this is something that actually will be considered as a qualifying income. The free zone person need also to consider maintaining adequate substance. And adequate substance, we can also consider it that actually this is part of the economic substance rules or reporting. The law did not really link this to the economic substance, but again, given the economic substance rules and actually what is required there, so actually definitely the purpose of it is actually to ensure that actually there is a substance over form for the operations within the free zone. And of course, as a third condition that actually having elected to be taxable at 9%, and of course there will be consideration for transfer pricing. So related party transactions need to be considered. If potentially there might be other conditions that will be clarified as part of the ministerial decisions, but again, this is something which is still open. So potentially there will be other conditions that we have to consider. So if these conditions are being fulfilled, so then 0% will be applied on the income of a qualifying free zone person. Federal and emirate level, and emirate government entities, or this includes the exempt persons. So the law has provided for a very targeted list of exempt persons. And this will include the government and government-controlled entities, qualifying public benefit entity, and the qualifying investment funds, and so on. So these are very targeted. There are many of them, or all of them, will require certain conditions to be met in order to avail. And some of them will automatically be considered as exempt, like government entities. So government entities includes ministries and the main authorities, the federal authorities and local authorities. The government-controlled entities it's fully, the government entities which is fully owned by a government entity. And normally we will see that actually there will be a list coming from the cabinet which will include all the government entities. So for any government entity which is assumed to be part of the exemption, if not included in the cabinet decision, then it will not avail the exemption. So we have to wait and see the cabinet decision, which will include all the government-controlled entities. So once it is there, then yes, it can be confirmed to be exempt from corporate tax. The extractive, non-extractive, natural resource exemption, this is again one of the things that there are certain conditions that need to be met in order to avail the exemption. And of course, the qualifying public benefit entity, there was a cabinet decision including all the qualified public benefit entities listed there. Anything else is not considered to be a qualifying public benefit entity and should be taxable. And the same for the public and private pension funds. So again, conditions need to be met. Partnerships and family foundation. So partnerships, so the unincorporated partnerships are going to be seen as a transparent entity. So actually the partners within the unincorporated partnerships are the ones who are liable to tax. They can elect that actually one partner will be considered as the main partner, and actually they can elect to be taxable at an entity level. So the law has provided some level of flexibility to deal with partnerships, as well as the family foundations or trusts. So again, the default position of a family trust is being taxable as an entity. However, again, there is a flexibility to deal with it as a transparent entity, so that the beneficiaries will be the ones who are taxable, and the entity itself will be exempt. Again, pros and cons of this need to be evaluated, but the law has just provided a level of flexibility so that each tax person will be able to decide which approach will be fine. Small businesses, again, one of the decisions that was out clarifying what a small business is. And it was highlighted that, if definitely the default position is that these small businesses will be taxable. However, there's a revenue threshold of 3 million dirham. So if that 3 million threshold has been exceeded, so then it will be taxable, and tax return has to be filed, and taxes need to be paid. And again, there is also a limit that actually this kind of threshold will be just until the end of 2026. So it is not something that actually it will last forever. I think the law has just provided that actually this is only for maybe 3 years. Potentially there will be other consideration, other change in the revenue threshold in the future. So again, it is something that actually it will be flexible, and that's why it was not mentioned in the law. However, it is through a decision, so that decision can be amended in the future. In terms of what is subject to tax, so the starting point for us always is the accounting net profit. So definitely this accounting net profit need to be arrived at through the acceptable accounting standards in the UAE. And of course, as we all know, that actually for any tax computation, we start with the accounting net profit. There will be other adjustments, and then we are going to end up with the taxable income. Taxable income will be, we have to take it and apply the applicable rates. We will definitely discuss some of the adjustments and actually what are the key areas for these adjustments in the next slides. For the UAE sourced income, and I think we discussed the non-resident persons. So non-resident persons who are driving, UAE sourced income will not be subject to tax, because actually currently, the UAE sourced income is currently set at 0%. This 0% withholding tax is the starting point that UAE has decided to take. So it's only 0% that actually will be applicable now. In the future, if there will be any change in the various categories of income, then this will be explained, or actually will be provided through a decision, ministerial decision, which is going to clarify, for example, if there is a dividend being paid to a non-resident, if it is a royalty, if it is an interest being paid to a non-resident, what would be the withholding tax rate. Currently, everything is 0% for now. There is no reporting for a 0% withholding tax. The main adjustments to a taxable income, and maybe we can start with the interest deduction rules. So in the interest deduction rules, we are talking about the net interest deduction. And net interest deduction has two rules. The first one is the general rule and the specific rule. So the general rule is actually you will need to consider your net interest expense and compare it to your EBITDA. And if it exceeds 30%, then whatever exceeds, you will be able to carry forward for 10 years in order to get the deduction in the coming years. You have 10 years to carry forward whatever disallowed from your interest deduction, which exceeds the 30% EBITDA. This is not applicable for banks for sure and the insurance providers. The second type of interest restriction rule is the specific interest restriction, which is mainly if you are getting a fund or a loan from a related party. But the law has also defined the purpose of that loan. So actually, if you are getting a loan from a related party for the purpose of dividend payment or actually capital contribution or anything related to getting a stake or a shareholder percentage in another related party, this is something that will be disallowed for tax purposes, unless you can showcase that actually this is not for tax to get a tax advantage. So you need to get that actually that the other related party is also subject to 9%, and there will be some sort of other documentation that you need to justify. If you are unable to justify the purpose of the loan, then any related party transaction potentially will be in risk. Treatment of unrealized gain and losses, and this is one of the very important things, especially when we are applying the accrual basis of accounting, and therefore we have certain elements which are subject to valuation, and investment securities which is subject to valuation. So definitely you will always get unrealized gain and losses in your OCI, or within your comprehensive income statement. So the law has provided that the default position that these gains and losses will be subject or be part of your taxable income. However, you will be able to elect so that you can recognize the gains and losses based on a realization basis. So you can elect for realization, and this means that you will only tax the revenues or the gains or losses which are really realized in your financial statements. Again, considerations need to be taken also on the deferred tax implications, because actually if you go to the realization basis, again, there will be differences between your tax base and accounting base. So again, further analysis will need to be done. Tax losses, so you will be able to carry tax losses indefinitely. But if you have tax losses, you will be able to offset against the profits of the next year up to 75%. Whatever remains as a tax loss, you can carry forward up to the following tax periods. Entertainment expense is one of the areas that it was mentioned clearly in the law in a particular article that there will be 50% disallowance when it comes to entertainment expense to customers and business partners and so on. So I think, potentially there is no mention as to, entertainment expense related to employees. So potentially this will be clarified according to a decision if this really will be the case. The non-deductible expenses, there will be also a general rule that anything which is not related to the business, to the taxable person's business activity, it will not be deductible. And that's why it is very, very important to consider various types of expenses, because you will find, for example, in your organizations that there are business-related expenses which is being given to employees. However, it's partially used for personal capacity. So this is something that actually, we need to consider. Potentially there will be some sort of, allocation, some sort of, knowing exactly what is business-related, what is not business-related. If we can see other jurisdictions, they can take or disallow a certain percentage of mobile phone expenses, cars, whatever. So again, the law was very clear, and even as part of the non-deductible expenditure article, again, if the expense is being used for various purposes, there will be a need to split the expense between the various purposes and see what is business-related, what is not business-related. Of course, we shouldn't mention that actually, fines and penalties and these kind of types is part of the non-deductible expense for sure. Donations, and I think we mentioned donations as well, that actually donations, when it's being paid to a non-public benefit entity, again, it will be disallowed. So, and now I think, with the cabinet decision, everyone is aware about the listed public benefit entities. So actually, if you are making donations to these entities, then you can claim a deduction of your donation. If not, so again, this is something which will be disallowed. Other adjustments. So what are the other adjustments? Again, the law has provided that potentially there will be other adjustments that we need to consider, but this will be clarified as part of the cabinet decisions or ministerial decision. But from looking at the entire law, what has been mentioned, what has not been mentioned, it's fair to say that actually, there are a few things which wasn't mentioned. For example, what about the bad debt treatment? What about the conditions that actually need to be fulfilled in order to get a bad debt to be deductible? What about the treatment of provisions, right? So the accounting provision that you are doing, is it deductible, not deductible? So again, a few things that we will expect that the law or the cabinet decisions will be able to provide in order to provide full clarity regarding your operations and what needs to be included in the tax return. This is part of the tax adjustments that can be done. Exemption of dividends and capital gains. Domestic dividends are exempt. So any domestic dividend that you are receiving from one of the entities that you are part of, that you are a shareholder in, so definitely this will be exempt from corporate tax. Any capital gains which you can receive from a domestic or a foreign participation, it is subject to the participation exemption rules. So there's a participation exemption rules which was there in the law, which definitely provide some key conditions for you to consider whatever gains or dividends from a foreign participation, for example, whether it will be subject to corporate tax or not, or exempt from corporate tax or not. And one of these is actually, if there is a participation, it shouldn't be less than 5% in terms of ownership and entitlement to profits. This participation need also to be taxable, so you cannot claim that actually there is a participation exemption from an entity which is not subject to corporate tax. For example, if it is in Bahrain, for example, so Bahrain, there is no corporate tax there. So actually, if there is a participation, if there is a gain which you are getting from a Bahraini entity, then this will be subject to tax here. Foreign PE exemption. So if an entity here, a corporate entity here, which has a branch outside the UAE, the default position that branch which is outside the UAE, it will be part of your tax return. So you are going to include that branch. PE is a branch. The PE revenues and expenses will be part of your taxable income. However, you will be able also to get the foreign tax credit, meaning that the taxes that branch has paid in other country, you will be able to get as a credit. So this is the default position. If you want to elect, the law as well mentioned that provided for an exemption for this. So meaning that you can carve out the PE out of your computation. So you can only deal with the UAE entity on a standalone basis, that this is the one that actually I'm going to file the tax return on, and I will be pay the taxes on. But actually there is one key condition, that in order to make this kind of exemption, that PE need to be subject to tax at least 9%. So if it is not subject to tax at 9% or more, then you cannot avail the exemption, right? So it is very important to consider the corporate tax rate applied to the PE, the foreign PE. Operating aircrafts and ships. This is a very common, especially in double tax treaties, and mainly it is part of the reciprocal kind of treatment. So this is mainly for non-residents who are operating in aircrafts and ships. So they will be exempt from corporate tax, provided that the resident person here in the UAE is being treated the same in the other country where the non-resident is coming from. So if this condition is being fulfilled, then the non-resident will be also able to avail the exemption in the UAE. Group tax matters. I think we heard about, and even since the days of the VAT, we heard about tax groups. And although there is a difference between forming a tax group from a corporate tax perspective versus a VAT tax group. So the conditions are not the same. For the corporate tax group, so there should be a parent entity resident in the UAE, which owns 95% of the other subsidiaries in the UAE. So actually there should be an owner and other subsidiaries in the UAE. Ownership shouldn't be less than 95%. All the entities need to be in the mainland, need to be subject to 9%. We can avail the condition that actually, for example, if the parent entity is in free zone, So in this case, in order for that free zone to avail actually to go with the tax group, so they may elect to be taxable so that they can form the group with the other entities. Of course, as we mentioned, that actually, we cannot, none of the entities within the tax group should be exempt or a qualifying free zone person. Group transfers and business restructuring, this is one of the also advantages which has been provided, or one of the reliefs provided by the law. And there is one just condition that actually need to be considered as well, that there is a common, there is a direct or direct common ownership of 75% between the group entities. And if there is a common direct or indirect ownership between certain group entities within the UAE, all of them are taxable, all of them having the same financial statement, financial year, then if there is a transfer of shares, if there is a transfer of business from one to another, if there is a business restructuring between them, then it can be done with no profit and loss. So actually, again, it will be done at a book value. The tax law is not going to consider any kind of gains or losses for this particular transaction. However, we have to consider one very important thing, that actually, after the transfer, there shouldn't be any further change in the structure for 2 years. So actually, there will be a clawback if any further transfer to a third party outside this qualifying group, which has the ownership of 75%, if happened during 2 years, then the earlier transaction, the first transaction, will be taxable. So, I think the law has provided a lot of things, but definitely we have to consider the key conditions which was included there. Transfer pricing, if we are forming a tax group, this will also provide a very good advantage from a transfer pricing perspective. Because, within a tax group, the tax group itself will be considered as one tax person. So it's only one tax person who is going to file one tax return. So if there is any transactions between the entities within the tax group, it will be eliminated. And therefore, there is no requirement for any adjustments from transfer pricing perspective. So this is one of the things that also could add to the advantage of forming a tax group. Transfer of tax losses, again, there will be consideration that actually, 75%, the qualifying group of, if we have a group of entities which has direct or indirect ownership of 75%, they can easily transfer losses between one group entity to another. So this is, again, one of the things that can be considered in the tax law. The TP requirements, again, transfer pricing or the arm's length principle has been introduced in the law. It's a very well recognized, principle. So actually, we are dealing with related parties as if we are dealing with third parties. So definitely, all the applicable methods of transfer pricing will be considered and has been supported in the tax law. There will be also advanced ruling requirement or advanced ruling regime, which will be there. In terms of the documentation itself, in terms of the disclosure, there will be a disclosure form which has to be part of the tax return that you need to provide the key transfer pricing or related party transaction as part of your tax return. The other documentation, which is the local file and master file, the decision was out, the ministerial decision clarifying that if it is a constituent entity, if you are a constituent entity of a multinational firm, which exceeds 3.15 billion dirham on a consolidated basis, or if you are, having a turnover or revenue 200 million dirham, then you have to file a local file and master file for transfer pricing purposes. Maybe just I will end here by the timelines of the corporate tax. So starting from 1st of June, the corporate tax law is going to kick in for any financial year. So actually, if your financial year is a calendar year starting from 1 January, this will be your starting point. If you are starting from 1 July, so you will be one of the early adopters of the corporate tax. Assuming that actually you are going to start with 1st of January 24, then this will be your starting point. You will have to, to file your tax return by September 2025. The local file, master file, will be something that actually we have to wait for the tax authority to ask you to file the local file master file, and you have to submit it within 1 month, and maintenance of documentation will be out. So the registration with FTA is something which has started already, especially for LLCs and joint stock companies. Nothing yet for non-residents or the PEs for non-residents. So again, this will be advised during the coming period, as well as for individuals. So with that, I think yes, I finished my slides, and I wish that I have given you some sort of a brief on corporate tax, and I will be here definitely through the coffee break and later in the Q&A session for any particular questions that you may have. So thank you very much for your attention.
For us. Before we go deeper into the subject, well-deserved coffee break for 15 minutes. We will see you back around 11 o'clock, please, in the same hall, and we will start with our panel discussion at 11, please. Thank you so much. Please join us for the coffee outside. We will now move on to our panel discussion of the day, and the topic is corporate tax implications on UAE businesses. This is where we will discuss and explore the implications for businesses ahead of the 1st June 2023 effective date. For this, I would like to invite Mr. James Faulkner, Director, London Stock Exchange Group, who will be moderating the panel. James has successfully managed to work with an impressive portfolio of industries ranging from governments, financial institutions, corporates, entertainment, and sporting firms. James, if you... Thanks. Don't do that. Thank you. And now I would like to invite on stage our esteemed panelists. Brian Moreland, CFO, National Bank of Fujairah. Mohammed Al-Swifi, Partner, Ernst & Young. Mohammed Yasser Zini, Founder, Waze ERP, please. Thank you, everyone. Over to you, James. Thank you.
Thank you very much. Thank you. Good morning, everybody. Thank you very much to the National Bank of Fujairah for arranging this knowledge series. I've been lucky enough to be part of a few of these. They've always been very, very insightful. They've always been very, very informative. So I'm pleased to be here once again. Thank you to my panelists. I'm looking forward to getting stuck in. But most importantly, thank you to you, the customer, the client. If it wasn't for you guys, then we wouldn't be here. So each and every one of you that's turned up today, we really, really appreciate it. So thank you very much. I would ask to ask some questions, please. So you've got your pens and your papers in front of you. Once the session is done, if there are any questions, then simply put your hand up and make sure that you pick the brains of our experts, because that's what we're here for at the end of the day for these knowledge series. And if not, you can always chat with them outside. But these knowledge series are all about building best practices, sharing best ideas, and more importantly, building relationships. So before getting started, if you don't mind, gentlemen, a quick 10, 20 seconds about yourselves, who you are and what you do, starting with yourself, Yasser.
Good morning, ladies and gentlemen. I'm Yasser Zeni from Waze ERP. We are ERP consulting firm and providing services in UAE since 2013. Our primary focus is to eliminate non-value adding activities from business processes and make sure business processes are in line with legal requirements like VAT, corporate tax, and other business regulations which are applicable to that business. By taking leverage on our consultants' expertise, we provide services to service sector, manufacturing sector, distribution, and contracting businesses. And thank you very much, National Bank of Fujairah and Definitive, for inviting me again for this event. Thank you.
Thank you, Mr. Mohammed.
Good morning, everyone, again. Pleasure to be with you again this morning. My name is Mohammed Al-Swifi. I'm a tax partner at EY. I've been with the firm for almost 1 year now. I'm leading the corporate tax introductions at EY, supporting our clients with the corporate tax introduction, as well as tax governance. So my key specialization is corporate tax and tax governance. Before EY, I was in another Big Four in Saudi Arabia for 2 years. And before that, I was on the client side, like you all, for almost 21 years as a regional head of tax in the UAE here. I was based as part of HSBC. I was regional head of tax for HSBC for almost 11 years, and 10 years as head of tax in Egypt for HSBC as well. So pleasure to be with you today, and looking forward for our discussion.
Thank you.
So just to finalise it, I'm Brian Mulholland. I'm the CFO of National Bank of Algeria. I've been in the UAE for no more than 9 or 10 months now. Before that, I started a bank, a challenger bank in the UK, and before that, I was the finance director of Coutts, which is the private bank and wealth manager in the UK as well. For this session, I'm probably a little bit more like yourselves than the other panelists. So, you know, I'm looking at the regulation, looking at how we as a organization can embed the regulation and take it forward in a pragmatic way. So hopefully I can empathize a little bit more with all of you, and we can take some good advice from the panelists that are up here.
Thank you very much. So an expert in ERP solutions, an expert on tax and accounting, a CFO, we really have an all-star lineup. So starting with yourself, Yasser, so tell me, how can an ERP system actually assist companies when it comes to managing and complying with this new tax regulation?
ERP plays a vital role when the objective is to comply with any regulations, especially corporate tax or other direct tax or indirect tax regulations. The first role of ERP is to assist you in data processing capability. So, and when you process data, you need to you are basically calculating your tax liabilities and tagging transactions with the right tag. So the first role of the first area where ERP assists you is tagging with the right tag and giving the right tax when when the transaction is processed. The second role is reporting. Return to the authorities is one type of report. And then there are a lot of reports which you generate internally. So the second area where ERP assists businesses, especially SMEs, is to generate different type of reports when it's required for planning purposes, for internal purposes, and especially when regulators ask for any specific report. The third area where ERP can play a vital role is monitoring and alerts. So when you try to monitor your all transactions from tax perspectives, you need overall framework which track individual transactions, which monitor your overall balances at balance sheet level or profit and loss level or on other levels. You need a framework which ERP gives you. So that's another assistance which ERP gives onto all industries across whatever sector they are working in. The fourth area where ERP gives assistance is enhanced accuracy. So ERP is all about proactive data processing. So for example, if we are processing transactions, instead of a department or human hours spent on verification of data processes in compliant or not, ERP give you this advantage that ERP will verify the transaction before it gets processed into your database, that this is in line with the rules already configured in ERP or not. So accuracy of transactions are enhanced. Last but not least, the planning and forecasting purposes. So if you are planning for a tax planning department or taxation department, they need specific reports in a specific format. So that's ERP can give you, and ERPs normally have a very extensive tax planning and forecasting reports, which really help these professionals to take this forward. Thank you.
Thank you, Yasser. Thank you very much. Mohammed, we've done a few of these sessions. It's been about a month since I've seen you. I know that you've been super busy. So I suppose my question, and something which is important for the audience to understand, is if you're that busy at the moment and I'm an early adopter or I'm waiting till the very end, is that a risk? Should I, take action now?
Yeah, I think this is very, very good question. So I think, of course, us as advisors, I think now we are extremely busy with clients. And we started the journey, I think, maybe before December, for the people who really consider that actually there is something really coming, and actually we need to start as quickly as possible or as proactively as possible, and especially with the very large groups. who know that actually there will be potential, very big risks. But we also found that actually still a very big bunch of, taxpayers didn't take any kind of proactive steps to maybe to reach out to advisor or even internally to make appropriate impact assessment of corporate tax. What does that mean to them? So again, I think it is very important to consider that once you go deeper into the date of implementation of the tax law, it becomes also, maybe it is a critical time for you to be prepared for that corporate tax. And at the same time, if you want to have support from external advisors, again, you will, there will be some sort of difficulty to get the right advisor for you who will be able to give you all the energy, all the support that you are expecting. So again, it's similar to the experience. I was on the client side, during the VAT implementation. And implementation date was 1st of January 2018. I started hiring the advisors in November 16. So I had more than 12 months to prepare and everything. This is, to be honest, even from a cost perspective, me as a client, definitely it will be different. If I locked the advisor long period ago, then actually, to reach out to the advisor, when there was just, few months or weeks before the implementation. So again, I really encourage everyone to do the internal assessment if you are not even going to hire any tax advisor, or if you need a tax advisor, so please proactively go and speak with advisors, get whatever support that you need as early as possible, because over the time, they may not be available, or actually there will be some sort of difficulty.
Yeah, very interesting. Good time to bring you in then, Brian. So what are the challenges that you're foreseeing with UAE companies when it comes to UAE corporate tax? And what would you say that National Bank of Fujairah are doing to ensure that their customers are remaining compliant?
Very good question, and one I wasn't quite expecting in that nuanced way. So, I mean, this today is part of what we're doing. We're trying to get the message out there because for us, we want to try and enable our customers. We want you to be in the best position you can be. We also want to connect you with the right other experts who can help you as part of a partnership grouping. Just talking or touching on what Mohammed said there, I mean, when we looked at who we could get to help advise us, we started relatively early, and absolutely can echo the fact that the later you leave it, the less available the experts are, and they are then struggling to find the right resource to support them with as many clients as they have. But from our perspective, we are willing not only to do these sessions, make the connections, but where there is a demand or if people talk about it, we can get forums, informal forums of groups together where we can help thrash out some of the issues. So we will do whatever we can. We'll offer our advice, if anyone wants to talk about what we've done or how we're doing it. For example, we're making quite practical decisions because, let's be honest, no one wants to pay more tax than they need to. Therefore, when Mohammed's talking about elections, sometimes you have to balance off, well, do I make an election here or there with how practical is that? So if I make this election, how much do I have to change my processes, my procedures? How complicated is that? And I think you have to start making practical decisions, and you can't always optimize the tax, but what you should be looking to optimize is the overall cost, whether that's cost in processes or resource vis-a-vis the tax elections that you can take. So there's just some starting advice.
Yeah, thank you very much.
Maybe just one thing also to add that for the early consideration of any tax, it's going to give, for example, the sectors. For example, if we are talking about a banking sector, real estate sector, and especially if they are interacting together through a particular forum or a certain body who is representing a sector, it is very important to make this as early as possible because actually, going to the regulator, going to the Ministry of Finance through, a bunch of, a sector representative is going to make also some sort of impact, which is going to drive, clarifications from the ministry, getting things more clarified, or trying to push on certain treatments as well, which is going to be of benefit to the particular sector. So these kind of, being aware of what's going to adversely impact the business or the sector wouldn't be considered once the law is out. It would be a bit late. But considering this as early as possible, I think this will be a very big advantage.
Yeah. The word early has come up quite a lot, so I'd like to actually ask the audience right now, a show of hands, who's actually taken some steps? Who's been speaking to advisors? Has anyone taken some action when it comes to the UAE corporate tax law? Just a show of hands, anyone? Wow, okay, I see. So, point in case, so people need to move and people need to act quickly, right? And that's why I suppose these knowledge series are so beneficial. Mr. Yasser, you mentioned before about the ERP system, it helps with planning, with forecasting, but how sophisticated can an ERP system be? I mean, would it actually handle tax exemptions, deductions? Can you incorporate that into payments? Shed a little bit of light on that, please.
So ERP have its own module for tax management. So ERP have its own module for tax management where you can really summarize your whole complete tax regulation. So it's from a transactional perspective. So for example, if someone entering an invoice, and so system can suggest what indirect tax going to apply, which direct tax going to apply, which accounting head going to be effect after this transaction is get processed. So ERP can accurately identify the transactions which are admissible, inadmissible, and the role of consultants and the finance department will be to configure ERP correctly. So if configuration is correct in the module, master modules, then the transactions in the other module will follow those rules. So when we implement VAT and excise in 2018, we identify policies, how if this particular customer or supplier buying these goods from somewhere, what 5% VAT will apply, 0%, or is exempt. So these rules are already there for indirect taxation. For direct taxation, important thing is where on chart of account this particular expense or revenue will go. Is a taxable head, is not taxable head, and from there system will decide whether when the tax profit and loss will be generated from the system, these particular balances will be there or not. But it's all depend on the configuration. ERP can provide you, ERP have these features where you can summarize or complete regulation there, and it will help you when you run your operations.
Okay, interesting. So very, very sophisticated, but it really depends on the inputs and the functionalities. So you need to know how to understand how to use the system to make it effective, I suppose.
So, from a configuration perspective, at master level, yes.
Okay.
On transaction level, no end user will decide where this transaction will go. It's a consultant of the tax department who configure the module. So instead of verifying each document after the transaction is processed, it's very easy to decide the policy, and whole company will follow the policy because they are using ERP, they are speaking same language. When they try to process information inside an ERP system, will verify the documents and process it in the right way to the departments. So on master level, yes, dependent on input. This input will be given by professionals, tax departments, and then the other departments, sales departments, procurement team, fixed asset team will follow the process. They cannot change the tax heads, they cannot change tax, indirect tax policies. They will just follow what is configured by the tax department. Okay. So it's really sophisticated, and the risk of error is reduced.
Interesting, interesting. Since there were a few early adopters here, and when I was sat listening to your very interesting presentation, Mohammed, you mentioned some highlights, 20 chapters, 70 articles, 40 open points. For the audience, explain what are some other key definitions within the law?
So I think, as we discussed through the slides, I think we stopped at, certain elements and certain terms which the law has provided, for example, like the qualifying income, for example, when it comes to free zones. What does that mean? So it is something that actually, we haven't seen before. Actually, it is not a usual kind of term. It will require further explanation by the tax authority. Nexus is another thing that actually we have to wait and see what do we mean by nexus, because it may open the doors to a number of other activities for a non-resident person in the state, in the UAE, which potentially is going to bring non-resident person to be taxable in the UAE. So definitely we need to understand what do we mean by a nexus in the definition of a PE. Few other elements like, government-controlled entities, government entities, what do we mean by this, what do we mean by that? Again, there is a differentiation between government entities and government-controlled entities. The conditions that need to be fulfilled as part of the exemptions, as part of all the provisions that we have discussed in terms of the conditions applicable for exempt entities or forming a group, or also the participation exemption. So we have seen that actually there is a lot of definitions, there is no particular terms there, but actually, again, if you go to the definitions, again, if you go to the conditions, you will find that there will be a lot of things that we have to consider. So I guess with the clarity that have been arrived so far, I think around 13 decisions, which give us some level of clarity regarding some key elements, but the coming ones are potentially more significant. So I think the free zone point, I think this is something that I think it requires a lot of attention from a government perspective, and that's why it is taking a longer time to be released. Hopefully, from now until the end of June or beginning of June, not beginning of June, actually, definitely end of June, because we are beginning of June next week. So yeah. Anyway, so I think, during the course of June, I hope that actually there will be further clarity coming in relation to the remaining ones, which will clarify the terms that we have explained.
Thank you, Mohammed. Brian, I'm curious, through your experience, what additional resources should companies be allocating to comply with this new tax regime? Should they be acquiring ERP systems, additional staff, stick to what they have? I'm curious just to shed a bit of light on that.
So I suppose I can only really give our example, which is probably the most pertinent. So in terms of where we're at the moment is really the initial analysis and assessment phase. So to do that, we know we're bringing in an outsourced partner, both to do the initial assessment with us, but then to do the implementation and the embedding. What we're looking to do, because ultimately we would want to have more ownership of that going forward, we're also looking to recruit our own small tax team to complement that, so we start to build our own understanding and our own knowledge base at the same time. In terms of an ERP system, once we get to the implementation, then we'll look at our systems and look to see how we embed it, either with our current systems or indeed putting an ERP system across a lot of our information if we're not already sourcing it and processing it in the right way. So for us, it's starting, now in terms of, well, what can we do? What is the tax going to mean for us at the highest level? Let's be honest, I looked at the regulation, I thought, government entity exemption, National Bank of Fujairah could be lucky here. Within about 3 seconds, that was diminished, and I got back onto the phone and said, look, we really need some more help and advice here. So it really is about go to the right people at the right time, take the advice quickly, and make decisions quickly, because even though, and as Mohammed said, even though all the tax guidance isn't there, a lot of it's there. And if you wait for it to be perfect, you probably won't have enough time to actually go through all the analysis phase yourself. So I would say go to the right people quickly, try and build your own knowledge, because at the end of the day, you still own it. So no matter what you do and who you get to give you support, you still own it. And ultimately, the tax authorities will be coming back to yourself for the answers. They won't say, oh, it's okay, you've got an outsourced partner for that. Or they won't turn around and say, we understand you didn't quite understand what it was. I mean, the tax authorities are definitely gearing themselves up here to be incredibly robust. And of course, that's no different than any other jurisdiction in the world. But I think we, on the other side of it, need to be practical, pragmatic, but also prepare ourselves for what's going to happen, not just over the next year, but over the next 5 years as everyone learns how to embed this properly.
Yeah, well said. And you said not just over the year, but the next 5 years. That's why these NBF knowledge sharing series are so important, right? Because it's free information, everyone's in it together, and it's just really good to build those best practices and share ideas. So even more reason for these knowledge series.
Yeah, I mean, look, we love these knowledge series. We love them as an opportunity to meet with customers, but we also love it as an opportunity to just share information. And for us, just so you're aware, we're looking and we're in the planning stages of the next series of these. The types of topics we're considering are around trade finance, ESG, all very topical aspects, and potentially even treasury. So I would advise you to give us feedback, use the QR codes or speak to anyone at NBF and let us know what you're interested in. We can give and put these series on, but if you're not interested in the topic, it doesn't make much sense. So please do let us know, and then we can tailor it to your wider needs.
That's great. And a little bit of a sneak peek, by the way, there to the customers and the clients for some future knowledge series that are going to be coming up. Mr. Yasser, so give me an example. Lots of talk about an ERP solution. So give me some examples of tax compliance challenges that customers could be facing in the future then.
Due to the nature of ERP implementation, there are business-specific challenges out there. What I'm discussing now is the general challenges, which is from the overall business perspective. The first challenge is a complexity of regulation itself. The regulations are not static in their nature. They are dynamic. They change time to time. And ERPs, when ERP is, if ERP is new in the business environment, with the business where we are implementing, the biggest challenge is the complexity of regulations and how to incorporate those changes into ERP, and it is the biggest challenge. So feature is there in ERP. Every ERP have the module where you can incorporate the changes as they arrived, but the risk is departments either missed the updates or the tax consultants are not there to review them regularly, so they can explain them that after a quarter, this is going to change, this policy going to change to this percentage, this accounts will be admissible, inadmissible. So these type of changes are continuously required. So the complexity of regulations itself need to be acknowledged in the ERP. Module is there. This is the biggest challenge which normally a company faces. The second thing is integration. In a group environment, there are a lot of different schemas. So, for example, if I have 2, 3 subsidiaries, and these subsidiary schemas need to be merged at the end to produce reports and returns. So if mapping is wrong and mapping is not checked before it's go live, this will cause a lot of problems at reporting level. So ERPs normally give testing feature before go live with integration module or integration routine. Check what will be the outcome. So and test based on your previous data. And now we have independent tools which run or test your test points through systems. So no human have to sit and run your test case one by one. There are the softwares who will run the whole test case for you and give you a report. So that's another challenge which normally when we implement ERP we face. The third thing is traceability of transaction. So there is a record itself which is in database, and there is a source document which need to be connected with that transaction. So ERP gives you an archiving module where you can archive your electronic copy of your original document. An original document can be in your physical archives, and this electronic document you can tag with your transaction. So this will improve your traceability. So whenever any transaction from your database come out, it will come out with the electronic copy of original source document from that particular transaction is materialized. So this is these three challenges are very common. And if the organization is growing, the problem is scalability. So for example, this year, my total records was 500,000. Next year, 1.5 million, then 2.5 million. And this scalability required more manpower, man-hours. And the second thing is your database need to be neutralized against the volume. So that is scalability is the biggest challenge. So in ERPs, now we have AI-based tools which reduce your man hours. If transactions are repeatable transactions, implement that AI-based bots. So what will happen when source document will come, AI will activate it and pass those transactions instead of any human being, read the email, prepare the invoice or delivery note against those emails and send. Bot can do this for you and save a lot of hours. And similarly, when it's come to data, size of data, you have to check your data centers, you have to check your capacity, keep eye on your capacity, so you will not surprised when reports are not running or database get crashed due to volume issues. So this is one of the technical challenge from technical side. And the last point is adaptability. So some softwares are specifically designed for specific industries. And so for those industries, ERP will give you adaptability. But if you are working in group environment and the processes are going to change, check adaptability of your system in the first go before implementing it to a new business, because this will give you many other challenges. Integration will be the challenge. Reporting will be challenge, monitoring will be challenge. So whatever you configure, adaptability is a key. So if you are going for ERP solution and this is industry specific, and you are investing in another subsidiary, do not just copy and paste that schema into a new system. So adaptability is key. So these are the key challenges which we face normally when we implement ERP.
Right, yeah, quite a lot and quite thorough. So adaptability, integration, scalability, it really is quite thorough. So once again, if there are any questions on ERP, on the solution, then don't worry, Yasser's going to be here for lunch, so please pick his brain. Mohammed, you mentioned before about VAT when it kicked in the UAE. It was 12 months, I believe, in terms of preparation. Of course, we have some early adopters here, but are there any previous lessons that we can learn from the VAT phase that we can implement as a best practice now?
Yeah, of course. So definitely, I think we know one of the very important things, but potentially I mentioned it before, is really to consider the common issues related to the sector where we are operating in. So it helped a lot to lobby with other, financial services and other banks during my time to discuss and agree the burning points that we are facing. And we raised it with the FTA at the time. We got from them some sort of resolution to our issues, or at least some sort of guidance how to deal with it. So similar from a corporate tax perspective, again, so it is very important to understand to understand the law, how it's being applicable to us. Identify, given the nature of my operation in my sector, and it wouldn't be only my issue, it will be the issue of other organizations within the same sector. So potentially maybe we can go, as a group, discuss it through a regulatory body or individually or all together as one letter to the Ministry of Finance. This is going to give a level of strength to the message which is being given. Of course, there will be some sort of traction and consideration from the ministry when they see that actually there are many impacted taxpayers regarding a particular matter. So I'm sure that there will be some further clarifications, some sort of reaction from their side. So that was one of the very important things that I can consider during the VAT time. In addition, of course, to other elements like what Yasser has mentioned in terms of the systems used. do we have the right systems? Do we need to do any kind of enhancement to our systems? So this is something that is not going to, it's not just a switching on the button. So potentially, it may or may not. It may take, it could be a very quick process. It could be a lengthy one. So which approach that actually we have to avail in order also to consider the resources that we have and the requirements that we need to deal with and the data that we are having as well. So this kind of assessment, if we are not doing it during the coming period, I think could potentially pose certain difficulty.
Interesting, thank you. Brian, as CFO, how does this new corporate tax, this new regime, going to change the way that NBF does business with its customers? And if so, are there any preparations that maybe some of the audience can learn from it?
So I think first and foremost, it won't change the relationship at all in terms of what we do. So, NBF is here to serve our customers. We're here to provide you with services or advice and in ways that make sense to you and support as well. So it won't change any of that. And the fact that there is a central taxation piece coming through in terms of corporation tax, I mean, that clearly, in that instance, will affect our shareholders, but it won't affect our customer base in any way whatsoever.
Yeah, okay.
And I think that's the sort of advice I would try and give to everyone. It's first and foremost, you've got to keep focusing on the business that you're in. Whilst implementation of a corporate tax is something we have to consider very carefully, and we've got to focus on it. We can't let that focus take ourselves away from what our business actually is. Because if we don't keep doing the right things for our customers, making the profits, then there'll be nothing to tax in the first place. So please, in the same way that we are focusing on our business more than we're focusing on corporate tax, I would encourage everyone to do the same. But of course, take it seriously.
Yeah, indeed. Don't forget about the bottom line. Just one more question each from each of the panelists, and I hope that the audience, you've got some questions, you're writing down some queries or some questions for our panelists. So you mentioned scalability, adaptation, integration. Are there any best practices that you can give advice to the audience when it comes to integrating tax compliance processes?
So ERP projects are agile projects in nature, and the best strategy to deal with agile projects is create iterations. And the best practice is to create 3-step iteration process. The first stage is identify your requirements. So your requirements, to list down a requirement, use a model. Like there are a lot of models, but I like Moscow model. MO means must required features, S is should required features, CO could required features, and W are your want features which you need but you don't know when. So once you know your requirement as of now, then identify a right software solution with right integration partner or implementation partner. Once you identify and complete your step 2, it means that your ERP is live, you're processing your information in it and getting reports. Now come to stage 3 and check what are the things which are remaining. And update your step number 1, your Moscow analysis, and then start the iteration again. So this is a continuous process. You will have every 5 years, every 3 years, big iteration project, and then small iterations in terms of maintenance, upgrades, security upgrades, and different type of integrations with new softwares. But it's a continuous process. If you stop this process and try to start again after 2 years, then it's an additional investment, and sometimes you lost. Normally you heard from many businesses that we have 5-year data in different database, and after the 10 years data in different database. This is the reason when the iterations are not working. So if you work ERP projects, especially in iterations, it will be continuous project, and the benefit of this is you will keep your everything with you when you move to next ship and bigger ship.
Okay.
So this is the best practices which you can follow.
No, well said, very interesting. It's a continuous journey. So Mohammed, what impact is UAE corporate tax going to have on companies, let's say, tax governance or tax policy frameworks?
Yeah, sure. I think it's if a company did not consider that, the introduction of VAT could be a trigger to form a proper tax governance, and when we talk about tax governance, it means that actually we know that actually who is doing what in the organization when it comes to tax. We know that actually the board are aware about the tax risks that we are managing, and they are aware that there are certain controls that we are putting in place in order to manage. So this is, in very brief terms, what we mean by a tax governance. So if the companies did not establish tax governance when VAT was introduced, so I guess now with the corporate tax introduction, I think this is an important trigger to think about having a proper tax governance in place as soon as possible, because we are now in an era which is different from 5 years ago, right? Before the VAT, there was no tax in the UAE. Now we are in a different era. We are in dealing with tax authorities now. There are 2 regulations or more. There is a lot of underlying tax risks which we need to manage. The nature of tax that actually it always carries a level of risk. There is a lot of uncertainties. So how we deal with uncertainties? So without having the key components of a tax governance, which is starting with having tax strategy document supported by certain policies, considering also the technology tools that we are using, because definitely this is going to help us as well getting the right data and consider the accuracy of our data in sending to the tax authority. This is very key. Identifying the key tax risks and establish tax registers to record our tax risks, putting the controls, assigning what are the tax risks and who is responsible for each tax risk. And ultimately, the awareness and the reporting of these tax risks to the senior people within the organization and the board to be aware of what we are doing, what are the risks that we are facing, and what is ahead of us, because corporate tax would not be the final one. We talked about Pillar 2. We talked about potentially maybe a few things which may come, in the future. So again, this is something that actually it's growing. It's not something which is going to stop. So definitely we need to have, a proper framework in place, supported by the senior management of the firm, who are going to cascade the knowledge or the importance and going to support the finance and tax function in doing the rule as well. Because without the support of senior management, I don't think, the tax function or the finance function will be able to influence the entire organization. So this is very important. So it's an entire framework that needs to be built or enhanced if we have one. So I think it's very important to visit the governance structure that we have.
Indeed, thank you, Mohammed. Yes, extremely important. Brian, instead of maybe going in and asking you a question, you've obviously mentioned the importance of sharing best practices, sharing ideas, and that's the whole reason why we have this open forum. And I've obviously emphasized the importance of having you, the customer, the client present. So I want to kind of open up to the audience and just a show of hands maybe and do some Q&A, because I think it's good to have some open dialogue and to get some thoughts from yourself, the customer. You've made the time to come here, so I'd love to hear from the audience if there are any questions at all on the UAE corporate tax or regarding ERP solutions on the accounting side. You've got the experts here, so I'd love to know if there are any questions from the audience.
Could you please explain how it can be incorporated to the systems, existing ERP systems? This module can be incorporated? Because we are using these ERP systems, but that is not compatible with this corporate tax.
If your vendor is active, they definitely have this module. Maybe either you didn't subscribe for it, or so every vendor, their own vendor, have its own direct, indirect tax management module, and it's not work in isolation. It's only a master configuration which you do in isolation, but this all configuration will go into other modules, in sales module, in fixed asset module, in expenses, in bank payments and bank transactions. So each ERP provider have its own module, and if they don't have, they provide you APIs to build your own. So, for example, if some softwares are industry specific and then they are very specialized in processes, then they say that we have open API for you, build your own application and integrate with the ERP, and ERP will reflect to those master settings. But it's all about, you know, if this is the case, you have to start much time earlier. If you're building APIs, to build an API is to building another software from scratch, which have its own phases. So if this is the case, and you're not going to want to switch your complete ERP, and you're building your API, then you have to think of something, building your own application, and then integrate through API to your existing application.
Thank you.
Thank you. Very, very good question, actually. And I love the fact we've got lots of hands going up. This is brilliant. So you gentlemen, you were first, and then we can move on to the gentleman to the right. Thank you.
Sorry.
And if you could state your name and where you're from.
Yeah, sure. My name is Jassim Al-Masoud. I'm the CFO of National Resources Group. My question is related to, or more emphasized on the real estate. Like we heard about reverse migration, about the real estate. Everybody's shifting their real estate company to personal names. There will be a rule against that, or they will be taxable in the future? Any, I understand that basically there is if it's not licensed, so it is untaxable. Just more emphasize on that matter, please.
So yeah, I think we discussed this as part of our discussion when it comes to the natural persons doing business or business activity. And the key thing is, you know, if the individual person is, is part of his income, or actually is investing in real estate on his personal capacity, and this kind of investment, when we say investment in real estate, so it's buy and sell, renting, leasing, you know, this is actually the activity which has been explained in the law. If I'm doing this on my personal capacity, potentially in many of the cases doesn't require me to register with any of the licensing authorities. However, if I have, and in certain cases this is the case, that actually for individual persons who have multiple properties, they have they have number of properties to manage everywhere, and actually within the UAE, potentially outside the UAE, then they will establish a company which is going to potentially own these properties, and at that time, definitely a company will be registered, and actually it will be liable to tax. So again, I think based on the activity itself, and if we are talking about real estate, so up to what extent we are dealing with this real estate, and are we forming a company or not, or it is just on the personal capacity of the individuals. So this is something that actually we need to consider, up to what extent it will require any kind of licensing or not. But back to the point that actually if there is no licensing on the personal capacity, or the activity that I am doing as a person doesn't require me to be licensed with any of the licensing authorities, then it is not in the scope of corporate tax registration, so I don't need to register for corporate tax. Provided that also I'm not doing anything else, so potentially I will be doing maybe other investments on my personal side, which is potentially may trigger me to be licensed with any of other. So we have to look at the entire thing as a whole. But if we are talking about real estate investments, so yes, so this is the trigger.
Thank you.
Actually, my name is Sebo. I'm from Gemini Technical Industries, from Gemini Group. Starting, I would like to thank NBF for the opportunity for participating in Knowledge Series 2023. My question to Mr. Yasser regarding the ERP system. Since we are already using ERP system, we supposed to club with our developer in order to add it or the module to our ERP system. My question, whether after finishing doing this part, is there third-party company or consultant to give us the approval that we are on the right track, firstly? And then, should we take the approval from Ministry of Finance that we are doing according to the law? This is my question to Mr. Yasser, but I have another one to Mr. Muhammad after.
Sure, let's go with Mr. Yasser first.
So, so for example, if I build an application and I want to verify the purpose of that application is served or not, I will appoint an advisor to check it's fit for their requirement or not. So for us, when we started in 2018, FTA accredited vendor program was not there. It was in process. So what we did is we incorporate indirect taxation module, and the auditors, EY, KPMG, and Big Four, they did it for their clients and said that, yes, this is what we are looking for. And once the FTA issue the guidelines for software vendors, all the vendors go to FTA, submit their technical and functional documentation, and based on that, they get listing on FTA website. So if FTA fits, they will do the same, give us the guidelines with functional and technical requirements, which must be in the software if those softwares need to be in direct taxation environment. And from that list, you can use the vendors. But if you have your own customized ERP and you're building your own module, the best thing is once the module is done, ERP is live, take accreditation by your own tax consultants that this is what you are looking for. And you will get that.
Well, thank you. My question to Mr. Muhammad. Mr. Muhammad, now the question, we need to pay the tax according to the profits. Once we have bad debts, because as you know, most of the market, whether in UAE or in the region, it's credit market. So basically, I'm giving a service now or I'm selling now on a credit terms, whether later on, after the end of the year, this one happened as a bad debt. Is it reversible? Or we supposed to consider it on next year, financial year?
Yeah.
Thank you.
This is a very good question because, as we mentioned, again, this could be part of the areas which are yet to be considered as well, because in the normal case scenario, when we talk about bad debts and write-offs of a debt or whatever, according to tax laws, there will be certain conditions that need to be fulfilled and certain steps that you, as a tax person, that you need to fulfill in order to ensure that your bad debt will be deductible for tax purposes. This has not been explained yet in the law. And that's why this will be part of the other adjustments which will be explained. But if we can get the best practices everywhere, apart from the UAE, so definitely you should have taken all the relevant steps in order to get your debt from the other counterparty, right? Potentially, if you raise the legal case or whatever, potentially you should have done that. In terms of writing it off, so again, you need to have the evidence that actually, internally you have taken all the right steps, and there is a conclusion from the senior management that actually, yes, we need to write this debt off. Maybe from a tax perspective, we need to be mindful of the fact that, for example, if we are starting the first tax year, say January 2024, and of course, we started the year with certain debts pertains to the period before the tax law. And we concluded in the future, once we became taxable, that there is a debt that we need to write it off, right? I'm sure that definitely, any write-off which is going to take place directly to the P&L, it will be subject to the new rules, which is going to be issued according to the law, because simply you will be deducting from your current profits of the taxable year. And in order for you to do that, there should be certain conditions that you need to avail or to ensure that actually it has been fulfilled so that you can evidence this to the tax authority when they come for the inspection that you have done this and this and this. Or potentially they are going to provide some sort of guiding rules, especially if the debt is related to years before the tax law. Because this will be something, it's a new law, new thing, so actually what about the past? So this is something that But I think, maybe as a first step that we need to consider that we need to be mindful of that actually there will be further rules that actually will need to come to justify or actually to provide you with the conditions that need to be met. We need to ensure that actually, or to have a list of these debts, we have to consider, whatever debts that we have prior to the law, so that we can, be aware of what kind of next steps that we have to do once the new rules are out and once we become taxable and start the first taxable year. I hope this answered the question. Unfortunately, this is one of the areas which we need further clarity once the additional or ministerial decisions are out.
It's a very, very good question. Thank you.
Thank you, NBF and the team who presented very well. My name is Jose. I am from Emirates Business Group. My question is that in the previous session, you were talking about the withholding tax. We are actually importing raw materials from European countries, which is subject to corporate tax, and all the shipments are coming CIF. So there is an element of revenue probably for the overseas company for the insurance and freight inland. So is there any withholding tax requirements for us when we are making the payment to the supplier?
So just repeat and ensure that actually I understand the question correctly.
We are
So
actually importing
you are making payments to
making payments.
You are making payments to other entities outside the UAE, right?
Yeah. We are importing from Europe mainly.
Yeah.
So all the shipments are currently coming CIF, including insurance and freight.
Yeah. So this payments pertains to goods, not services.
Goods, yeah.
So mostly, in most of the jurisdictions, there is no withholding tax to be applicable on goods. Normally, withholding tax is applicable on, consultancy services, technical services, royalties, payment, dividends, interest payment, but no withholding tax should be applicable on payment against goods imported or whatever.
But the insurance and freight, there is an element of service when the shipment is coming CIF.
Yes, so currently there is no withholding tax on payment even in the UAE. It's even for all type of importation or payments to non-residents. So it's currently set at 0%. Further, during the law has explained that actually it's 0% or any other rate which will be stated according to ministerial decisions. So we have to wait and see. Maybe in the future there will be another ministerial decision which will come up with certain categories of payments which are being made to non-resident persons, and there will be different rates to be applied as a withholding tax rate from UAE while you are making the payment. But not now, it is subject to 0%, so you shouldn't worry about this at the moment.
Thank you.
Thank you very much. I know a gentleman over there, please, and I'm aware there's two other questions coming, but to the gentleman on this table, please. Thank you.
This is regarding the subjectivity involved in interpreting some of the IFRS standards and try to account it. And while doing so, there could be an element of subjectivity which can border between tax planning and tax deferment. So how FTA is going to address it when you apply those standards and try to account and arrive at your profits? So is there any guidelines coming in general terms you expect that to happen, or what if we wrongly applied? The possibilities are that after 2 or 3 years somebody could come and tell that, look, the way in which you're approaching that one is a little bit wrong, and not entirely wrong. So there is a possibility that these are not applied by various business across the UAE in a standard manner. That's point number one. And also my next question is regarding the 40 points, which is open points, which is pending with the cabinet and the ministry. Do you think there are some extremely critical things are pending which could change the complexion of what we know about the corporate tax?
Sure. Maybe regarding the first one, I think we need to be mindful that actually there is an anti-abuse rule in the law. And what this rule is saying that, for any arrangement that the taxpayer is doing, which the primary reason for it is to get a corporate tax advantage, this can be classified as an anti-abuse, and definitely this could be an abuse to the corporate tax law, and potentially the tax authority will have the right to make particular adjustments to the arrangement or the transaction that has been done. So that's why actually for any change or any arrangement or any treatment that you are going to apply from an accounting perspective, which did not exist before, so you need to consider the corporate tax element and whether this will be classified, are you doing this mainly for corporate tax to get a corporate tax advantage or not? Or it is for business reasons. There are a few other commercial reasons that actually will trigger you to do this kind of transaction. So it is very important, and thanks for asking this question, because the anti-abuse rule is already started, from the 25th of October 23. So it is already there once the law becomes enacted. So it is, for any arrangement that you are currently doing now, you need to keep in mind that are you doing any particular change, either in your structure, in your financials, in your internal reorganization or whatever, which may be considered to be, only for tax purposes. It can be, but shouldn't be the primary reason. It may lead to a tax advantage, but actually it shouldn't be the primary reason. It should be driven by your commercial needs, for your company and for your operations. This is the first one. I think in terms of your second question, regarding the ministerial decisions and whatever is being left, I think currently the Ministry of Finance are very keen to provide as much clarity before the start date of the law. And what is being left, of course, it is important. Many of them are important. As we mentioned, the free zone point and the clarity regarding free zones, which at least, majority of taxpayers will have a link to a free zone. So definitely this is one of the key elements, in addition to many others. So yes, it is important that, I can say that actually we have now almost 75 to 80% clarity on the law, but actually there are still pending 20%. It doesn't mean that actually we have to wait until everything is clear, because actually this may take longer than expected. And that's why understanding which are the areas which are pending is also very important, because in doing the analysis, we will know that actually the law is not very clear in this, and actually there is a reference to a cabinet or ministerial decision which is going to clarify this. So at least I keep it in my mind that actually there will be further clarity on this piece. However, I need to do the rest of the analysis. And then, of course, maybe once I finish, there will be further clarity which is coming so that I can close my gaps. So, yeah. So I hope this answers your question.
Thank you very much. We have, I think, 2 more questions. I know that I can see some hungry faces at the moment, so lunch is going to be followed shortly, but 2 more questions.
Yeah, question to Mr. Muhammad. Here in UAE, mostly businesses are owned by the family businesses. In the family businesses, most of the owners, they are using their personal assets, availing the facility from the banks and others. So these incomes which we are generating from these personal assets are adding to their business incomes. It will come under the preview of corporate tax when the tax implemented? This is my first question. And second question is the small businesses reliefs, which is 3 million revenues, under 3 million revenues. Those, suppose if it is in 2024, the revenue is less than 3 million. So it will no need to pay any corporate tax. So let's say if it is come in 2024, it is above 3 million, the revenue, and again in 2026, the revenue is less than 3 million. So what will be the treatment of the corporate tax? How it will be impact? This is my second question. And third question will be for the individuals who are in personal capacity, they are doing business and they are earning less than 1 million of revenue. So they don't have the license. So they have to register himself for the corporate tax, and what will be the treatment for corporate tax? So these are my 3 questions.
Thank you very much. So think maybe for the first one, so for family businesses, the family, or actually the key family member who's owning the business, this is whatever personal investment, it will feed into the main company, the main operations. There could be various things that can be done. So again, from what we can see, that actually certain family businesses, they carved out the personal aspects from the operational one, and actually they structured it in the way that actually there is no interaction, because actually once the personal assets is part of the operational assets, so again there will be a lot of areas that we need to consider, which is related to transfer pricing, because actually this is a connected party to the business. There will be a lot of payments or a lot of withdrawals from the business owner on his personal assets. So carving it out in a way or a form, this can be done. Whether it will be part of the preview of the entire tax of corporate tax expectation is yes, as long as it's going to feed into the same licensing or licensed entity. So if we are talking about an entity, however, there are part of operations and another part on managing personal assets, everything is going to feed into one. So definitely everything will be taxable. It will be part of my taxable income, so it will be taxable at 9%. The second question was in relation to the 3 million, the small business relief. So I think the rules talks about whether this 3 million has been exceeded in any of the years. So we definitely, you need to have this 3 million to be consistent for 3 years. I think I can validate the rules just to give you the precise answer to this. But definitely, whenever you exceeded the 3 million, you will be subject to corporate tax. So if you are less than 3 million, it doesn't mean that actually you will be exempt. You will remain to be taxable. You have to file a tax return, but there is no taxable income, right? When it comes just to, if you exceeded the 3 million, then this is at that time is the time that actually you need to pay tax at 9%. Whether we have to monitor the 3 million, whether it has been breached, I think there is a point in relation to subsequent years and the previous years as well. And if you exceeded the 3 million, it will impact your taxability status. I can validate this for you after this. If you are doing some sort of a personal investment or real estate investment, or even if you are earning your own wage or whatever, and there is no licenses in this, so regardless of the threshold, you are out of scope. You will be exempt, right? The threshold is when you are doing these activities through a license. And your income is, or your revenue exceeded the 1 million, then definitely you will be taxable. So the 1 million is a threshold in case you are doing a business or business activity, and business or business activity means that you are doing a licensed activity.
Thank you. Thank you so much. We have one more question. I think a gentleman put his hand up over there. I'm loving these questions, by the way, and don't forget that we're going to have lunch after, so if there are any further questions, then please grab these experts. But this is the last question, and then there's going to be lunch.
The current year we can spend 30%, and the remaining amount we can carry forward that.
Yes.
My question is, next year again, that year industry also will come. So how we can treat that?
So yes, the 30%, if you exceeded the 30%, you will be able to carry forward whatever exceeded for 10 years.
Yeah.
Right?
Yeah.
What was the last thing that you have, mentioned?
That okay. The next year again will come okay. And another assessments will come again.
You mean actually for the, so definitely this will be an accumulation. So definitely, in the following year, you have to account, or actually you have to assess your net interest expense and compare it with the EBITDA, right? Yeah. And then you will exempt part of it, and actually the remaining is going to be carry forward as well. So you need to get a deduction of the year's, the current year interest expense, and if it exceeds, then again it will be accumulated as part of the, the carry forward ones, and so on. When you will be able to, to get, to avail, or actually to get, to utilize the carry forward ones, is when you have 1 year, for example, that your EBITDA is less than 30%, so potentially it is, for example, 20%, so you'd still have 10%, which you can utilize, so then you can take 10% from your carry forward, interest from the previous years and utilize them, get a deduction for them, and so on. So definitely it's an ongoing process. You need to monitor your carry forward interest expense year on year and manage it in that way. So first thing that actually you need to consider the year in hand, and then see if you have excess or not.
Thank you so much. I know there's more questions, but I do apologise because we have to wrap it up there. I'm getting waves from people saying that's it. We've got lunch, everyone, but once again, thank you so much for your attendance. We really appreciate the questions. It's a super hot topic, so I think that you should definitely grab hold of these experts within the ERP solution space, the tax and accounting space. You've got the CFO here, so please make the most out of this opportunity to pick their brains and build those relationships. Can you please give them a nice round of applause? Thank you. Mr. Umair.
Thank you so much, James. Brian, Mr. Mohammed, Mr. Yasser, thank you so much. Again, a very practical discussion. Thank you for audiences for engaging with our panelists. At this point, I would once again invite Mr. Adnan Anwar, Deputy CEO, National Bank of Fujairah, on the stage for some final remarks before we break out for lunch. Thank you so much to our panel. Thank you.
Thank you very much. I didn't mean to take much more time. Probably we could have given more time for a question. But as James said, these guys don't need to eat. Grab them and ask more questions during the lunchtime. It's indeed a pleasure to see the house full right until the end. So hopefully you guys found the session interesting. What's valuable to us is to give us feedback, what other topics we can cover under the Knowledge Series banner. I think looking at the popularity of this subject, probably once we get more clarity on 40-odd matters which are still pending with the cabinet, maybe we can do a refresh and get the panel back later this year or early next year if that is of interest. But please give feedback through the feedback process and to various team members, and we would be happy to bring back topics of interest to you people. So I hope you enjoyed the day, enjoy the rest of the day, and thank you very much for coming. All the best.